A very good afternoon for those of you who just joined us. So once again, thank you for coming in time. We will begin at 5 p.m. sharp. So in the meantime, grab a bite, grab a drink, and we'll speak to you shortly. Hi, very good afternoon, ladies and gentlemen, dear young investors. Thank you so much for joining us here at our Trading Challenge Introductory Bootcamp. My name is Junkit and I'm from Phillip Nova. So today we are really honored to have invited a professional trading coach, Mr. Kar Yong, to come and speak to us about the fundamental and technical analysis, as well as how you can formulate your own trading plan for this trading challenge and going forward in your own personal trading journey. So just to give a bit of context, actually, this trading bootcamp is somehow like an introductory session, to a preparatory course for you to just come and listen before you start to embark on your trading challenge starting next Monday. So this trading challenge will last for 3 weeks, and we really hope that with today's session, we'll be able to share with you some of the key informations that you need to know about this trading challenge, as well as to also hear from the expert, Mr. Kar Yong, about his experience and his knowledge in Forex and CFD trading. Okay, so before we move on, just a disclaimer here that anything that we share here today is only for educational purposes only, because we do not take into consideration each of your own financial situation, investment objectives. So whatever we're doing here, we are trying to educate you, to share with you what we know and what we have, and we hope that this will be able to benefit you in your own personal trading journey with Phillip Nova. All right, looking at the outline for today, we have a few agendas to cover. So the first agenda, or the first two agenda will be covered by myself. So once again, my name is Junkit from Phillip Nova. We will begin by introducing this Phillip Nova Young Investors Trading Challenge 2023. So I believe most of you who have signed up here, you guys are probably already a participant in this trading challenge. So I'm going to cover the key information, key mechanics on this trading challenge to help you better prepare for it. And next up, I will have a quick introduction on Forex and CFD. So these are the two products that you'll be trading during this trading competition. And from then on, Kar Yong would come online and to speak to you about something that is more insightful or more slightly a little bit in depth in terms of fundamental and technical analysis. And he's also going to talk about formulating a trading plan. So basically translating all the basic information into something a bit more actionable, something that can visualize and actually can just execute from there. Okay, and at the end of the session, we will have a Q&A session. Basically, you could type in any questions that you have in the chat box, and Kai and ourselves from Phillip Nova will try our best to respond to them. Okay, so A little bit introduction about who we are, Phillip Nova. We were formerly known as Phillip Futures, and we were inaugurated in 1983 as a member of Phillip Capital Group, and also the founding clearing members of Singapore Exchange Derivatives Trading. So this year happens to be our 40th anniversary. Okay, since we were inaugurated back in 1983, and since then we have actually grown to become one of the region's top brokerages for trading of stocks, CFD, Forex, futures, commodities, and more. So in short, we are a multi-asset brokerage firm in Singapore, so offering a wide range of products that you can invest and trade in. Okay, so now I think let us just move into the trading challenge that I think all of you should be very excited about, just like how we are excited for this trading challenge. Now, this is actually an annual initiative by Phillip Nova, also this Young Investors Trading Challenge. So we have organized this challenge for a few years now, and this year we aim for it to be a bigger than ever, with more participants and also with very attractive prizes for you to win. More importantly, we hope that you enjoy this process. And essentially, we aim to provide you with a platform, for novice traders or even for seasoned traders between the age of 18 to 30. That's how we define young investors. If you're 18 to 30, you're welcome to join this trading challenge, to hone your own trading skills and also to put it up against some friendly competition. And at the end of the competition, if you are the top winner, you'll be able to walk away with 1,002 Singapore dollars of trading credits. So that will be the grand prize for this challenge that we're looking at here. So that is for the first prize. If you come in at a second prize, we have a grand prize of $600. The third prize would get $300. And actually for this competition, we're just trying to benefit as many traders, as many young investors as we can. So there'll be a total of 20 prizes to be given out. If your final ranking is between 4th to 20th, you will walk away with $50 of trading credits. Okay, so there'll be a total of 20 lucky winners for this trading challenge. So today, really, this session is organized, or this session is designed to help you up your chances, compared to those participants who are not joining in this session. You stand upper hand, and hopefully you can walk away with these prizes. All right, and how does it work? Just to explain a little bit more about the mechanics of this trading competition, it will take place across 3 weeks. So over the span of 15 trading days, the participants or you guys will be using our Phillip MetaTrader 5 trading platform to trade Forex and a wide range of CFD products in a demo environment. So you'll be allocated an equity of $100,000. So this is basically just virtual credit. And we get this question a lot, like, do I have to pay to participate in this trading competition? The answer is no. This trading challenge is completely for free. And what's better than that? If you do well, you stand to win up to 1.2K. Okay, and at the end of this 3 weeks trading challenge, the winners will be determined based on the equity balance at the end of the trading challenge. Okay, so a little bit of rundown in terms of the sequence of event for this whole event. Today, 16 August, we're having our introductory bootcamp, and your trading challenge, the trading period, will actually begin on 21st of October, 5 a.m. Singapore time, which is next Monday. Okay, and it will run all the way for 3 weeks until 8th of September, 12 p.m. Singapore time. So at this point, I'd just like to remind all of you, let us all try to close our open positions before 12 p.m. on 8th September. So this is to make sure that you lock in your profits, and it doesn't, so that your final equity does not get affected by the sudden last minute moves in the market. That way you could, with more confidence, secure your ranking in this trading challenge. And at the end of the trading challenge, we will also have a physical closing event whereby we will announce the winners, as well as it will be a get-together event, basically, to announce the winners, a closing event, as well as also a networking event for all of you to just come in and to make friends from different unis or different walks of life. Okay. And I believe now some of you have already download the MT5 platform, and some of you, we see that you have started placing some trades. No worries. Basically, all your trading platforms, the trading access for all your demo platforms will be disabled this Friday, which is 2 days later, and all of your accounts will also be reset back to 100 grand on Friday. So this is to make sure that on Monday, 5 a.m., everybody starts afresh. Okay, everybody starts at 100,000 on Monday, and we will see who rises to the top from there. Okay, so giving a bit of glimpse of how of the background of our trading challenge. So last year, our trading challenge was actually featured on various news portals. So what we are seeing here is a feature on The Edge and also Yahoo News. And basically, our top winner last year, he manages to triple his 100,000 starting capital to just to triple that amount in a matter of 9 days. Okay, so I think this winner, he happens to be from SMU, and he was lucky to be featured on the news, and we see that he's doing well now in terms of career. So we do hope that we could see some of you, the more the merrier, to come and beat his record. We'll be totally excited to see that happen. And on your right, here are just some photos of the networking event we had. So basically, it was a really nice atmosphere. People with connections from all the local unis, from SMU, NTU, NUS, SIM, JCU, SUS, basically all the local unis we are in contact with, and everyone is participating in our annual event. So upon this trading competition, we do hope to see you personally at this event, where you can network with us as well as the peers from the same age group. Okay, and just to cover a bit of eligibility for this trading competition. So participant who wish to be qualified for the prizes, you must fulfill these 3 criteria. First of all, as this is a young investors trading challenge, so we want to prioritize, or we want to give the advantages to the young investors, which is the ultimate participant that we wish to have for this initiative. So you need to be between the age of 18 to 30 to qualify for these prizes. So if you're between this age group, welcome to invite your friends to join us as well. And secondly, the winner must not have an existing live trading account with the company already. So if you only have a trading challenge account, it is a demo account, it is fine. But the winners will be reserved for those who have yet to open a live account with Phillip Nova. And thirdly, we restrict in a way, not restrict, but the winners, if you want to win the prize, you must place at least 5 trades throughout this 3 weeks of trading challenge. Okay, so this is to make sure that nobody gets lucky, just by anyhow placing 1 trade and manage to rise to the top. So we also want to prioritize, want to reward, people who are actually serious in this trading challenge, and ultimately, your skill prevails and you will win the top prize. Okay, so this is the QR code that I flashed initially. So let's say if you're in the audience and you have not signed up for a trading challenge, you can scan the QR code on the left to join this trading challenge. So we do hope that you can just register for this trading challenge and hopefully be able to apply what you have learned from our sharing today. And on the right side, we have the QR code to our Telegram channel, where you will receive daily market updates. All right, so that is the conclusion of the first segment, which is to basically introduce to you this trading challenge. And by the way, if you wish to find out more information on this, we do have a page or on our website, or essentially just go and Google Phillip Nova Young Investors Trading Challenge. You'll find our page, and also on that page, we have a comprehensive list of frequently asked questions, FAQ. You can check it out, and hopefully you'll find your answer there. Okay, so for the next 10 minutes, I'll be walking you through the introduction of Forex and CFD trading, after which I'll pass on the time to Kar Yong to share with you a bit in depth on this space of Forex trading and CFD trading. Okay, so for this trading challenge, we will be running on the Phillip MetaTrader 5 platform. And this platform is actually the latest in the MetaTrader series of platforms, and it is the most advanced till date. Okay, and this platform, it comes equipped with a series of functions like auto trading function, advanced charting, and technical indicators for trading of Forex and CFDs. Okay, and it also comes as no surprise that this is one of the most popular trading platforms around the world. So for today's session, we'll be mainly sharing the things that we think would be more beneficial to you. So basically, like the fundamental, the technical side of things. We will not be going through the step-by-step guide of this platform, because at the end of this webinar, this end of the bootcamp, we will be sending you a follow-up email in which you can find a link to watch a short video on how you can navigate around the key features of this trading platform. So I believe all of us are young investors. It should be pretty intuitive for you to get your way around this trading platform. So we are confident about that. And while we have our limited time here, we wish to dedicate more time for our professional trading coach Kar Yong to share on his knowledge and share on his experience. All right, so firstly, let me introduce to you one of the products that you may be able or you are able to trade for this trading challenge. It is called CFD. So not sure if many of you have heard about this CFD, but it has indeed been gaining popularity in recent years. So CFD, in short, basically CFD is a short form. So it is derived from the term contract for difference. All right, and essentially CFD, it is an agreement between two parties to settle the difference between the opening and closing price of the contract. Okay, I believe that may be a mouthful, but contract for difference is actually a derivative, which I will be sharing on the next slide. It is a derivative, and essentially, what a derivative mean? Derivative mean is that you are not actually buying the underlying. You are basically trading based on a contract that is derived from the underlying asset. Okay, so essentially for CFD, it is an agreement between two parties. So let's say in this case, the traders and the broker. So we are the two parties to settle the difference between the opening price and closing price of the contract. Okay, and one important feature of this derivative is that there is no physical delivery of the underlying. You are just merely trading the price. And also, just like Forex, it is traded on margin. It is also a leverage product. So this means that you only have to put in a fraction of the total contract value, and then you'll be able to open a position much larger than the capital that you have put in. Okay. So the CFD basically, why do people trade CFD? Is basically to participate in the price movement of various kind of asset without owning the underlying asset. So let's say if I'm trading share CFD, I do not have to buy the actual shares and pay all the fees like the platform fees, or the exchange fees, the custody fees, and all that, and I just simply trade this CFD with the minimal cost, and also there's a lower barrier of entry to taking advantage of the price movement of the asset that you're looking at. Okay. So I think when we talk about CFD, I think it is important to explain about this concept between something that's exchange traded and something that is traded over the counter. So if you're looking at stocks and futures, so these are the things, or these are the assets that are traded over an exchange. So everybody will come to a centralized place, like Singapore stocks. Everybody goes to SGX or goes through SGX to change hands, to buy and sell. It will be all from a neutral spot, which is the exchange. But CFD, on the other hand, it is actually traded over the counter. Because why? Going back to the very definition of CFD, it is actually traded. It is actually an agreement between two parties, which is the trader and then as well as the broker. Okay, so it can take place anywhere, anytime. And when we are having this trade, when you're trading CFD with Phillip Nova, so this transaction only involves the two party of us, and it does not go through the exchange. So now I think this would also give you some context or some understanding when people say that something is OTC traded or something's exchange traded. So for CFD, it is traded over the counter. And in terms of the assets that you can trade on CFD, so you have indices, shares, ETFs, energy, commodities, and also more. Okay, so I think given the constraint on time, I will not be covering too much in detail, because I think we want to leave the good stuff for the airtime for Kar Yong to share with you. Okay, so just to cover some of the benefits for trading CFD, you got a small barrier of entry compared to the conventional way of trading. You also can trade in both bull and bear markets. You can also enjoy no expiration date. So unlike futures or other kind of contracts where you would likely have to face the risk of delivery. So for CFD, there is no expiry date. You can hold it for as long as you want. Okay, and the next up, it is also a zero commission traded product. You can trade however much you want. You don't have to pay a single cent of commission. And the next point is capital efficiency. So this is basically a universal benefit of everything that's leveraged. You don't have to put up the full value of this contract that you're trading, and you'll be able to achieve the magnitude or the effect of the large position with just a fraction of the capital outlay. Okay, and then very importantly, I think one of the key features of CFD is that you'll be able to hedge your position. So let's say if you're a long-term investor in a certain shares, so let's say in 5 years time, this share that you hold, you believe that it is going to go up in 5 years time, but in the meantime, within the next week or two, you think that there's going to be some bearish news on this particular stock, and you believe that the price is going to go down. So this is the best time, or rather this is the suitable place where you can use CFD, just to short the particular stock CFD, and then to take advantage of the intermediate downside move without selling your overall long-term position. Okay, so that is a very brief overview of contract for difference. Okay, so basically just to give everyone a concept on what the contract is, and just a quick recap, CFD is a derivative. It derives the price based on the underlying asset. And when you are trading CFD, it is basically merely exchanging the price difference between the price that you buy at and then the price that you sell at. Okay, and then next up, let's just talk about currencies real quick. So Forex, right? When you hear that people trade Forex, mostly there'll be a few main baskets of Forex pair. Okay, so the first one, I'm pretty sure we hear a lot of people say that major pairs, okay, minor pairs or exotic pairs. Okay, sometimes you even hear people saying under major pair, there's another subcategory called commodity pairs. Okay, so what are the major pairs? So these are the major currency pairs. So essentially, major currency pairs, you're looking at the 8 top traded currencies. Okay, so we have the US dollar, euro, Japanese yen, a British pound, Swiss franc, Aussie dollar, a Canadian dollar, as well as New Zealand dollar. So aside from US dollar, which is the king in the forex market world, you pair that with euro or Japanese yen or the British pound, you pair with any of these other majorly traded currency pair, you will have a major pair. And also these are the currency pairs that are most active in the forex market. People trade them a lot. The volume is great. The volatility is also great, which means that there will be always events that will trigger some movements in the market, and then there will be plenty of opportunities for people to come and trade these contracts and to benefit from the moves either in upside or downside. Okay, and next up you also have the currency pairs that are called the minors. So essentially you are mix and matching all the top traded currencies except the US dollar. Okay, so you just mix and match these top currencies, you get the minor pairs, or sometimes we call them the crosses. And next up, you also have the exotic pairs, which is not as popular. So basically, you're pairing any currencies, with a currency that is from the emerging market. So from a small economy, relatively small economy like the Thai baht, the Malaysian ringgit, the Hong Kong dollars, and all that stuff. So when you're trading into those kind of currencies, we call them exotic pair. Okay. Okay, so when you trade Forex, it is not like, when you go to the money changer to change money for your travels, right? You do not just trade in any amount that you like. So Forex is actually traded at a specific amount. It is called lot. Okay, so this also would dictate the number of currency that you'll be buying or selling. So there are mainly 3 lot sizes. The first one is a standard lot. So if you go on to MT5, when you start trading, you put in 1. You will be trading a nominal value, a nominal volume of $100,000. Okay, so that's a standard lot. So if you scale it down a little bit, you will have a mini lot, which is 0.1. So that has a notional value of $10,000. And then next up, the smallest one that you can trade or you can start trading with is with a micro lot at 0.01 lot. So that only has a notional value of $1,000. So I think in the world of Forex, right, there's always a misconception in terms of, oh, you need a lot of money to start trading Forex. So in the next slide, we will be examining, is that really true? Okay, and before we go there, here is a screenshot on the screen whereby the volume. So this is basically what you will see when you initiate a trade on the trading platform, and the volume there, it will tell you what is your lot size as well as the notional value. Okay, so in Singapore, Forex is actually traded on a 5% margin. So what is a margin? Margin is actually the amount that you would have to deposit in that trade, in order to take up the trading position. So this is normally a fraction of the underlying asset. And in Singapore, we trade Forex with a 5% margin. So let's say taking an example of a standard lot, right? So a standard lot with a notional value of 100K with a 5% margin, the amount that you have to use to initiate this position is only $5,000. Okay, so the mini lot you only need $500, and from micro lot you only need about $50 to initiate a forex trade. So I guess this answers the question or the myth that people need a lot of money to start trading forex. But no, right here, if you want to trade a notional value of $1,000, your initial outlay is only $50. Okay, and right here, just to go through a quick illustration for those absolute beginners, you have no idea how this transaction works. So let's say if you buy in a mini lot, 10,000 euros at 1.18, okay, and then 2 weeks later, the rate actually goes up to 1.25, okay, and just taking the rate that you sold it at later on minus the rate that you bought it at, you will have a $700 of profit. So the line that I just spoke just now is a super simplified way of explaining. By right, I should have gone through the inflow and outflow of the cash, but we will save the better stuff for when Kar Yong comes in and share. But in the event that you wish to revisit this slide or any of the slide, there will be a recording of today's session, which will be sent to you after this session. So be rest assured, all these will be taken down for you. Okay, so I think given the time that we have, I think it is for the best that we save the best for Ankang to share with us. So next up, he'll be coming in to share with you about the fundamental and technical analysis side of things, as well as how you can formulate a trading plan. So what I can say that what he has in store for you is really, really good stuff. We do hope that you can pay 100% attention during this time, basically just to benefit from whatever that he has to share with you. And before we go there, just a quick introduction for those of you who do not yet already know our trainer for today. So his name is Kar Yong, and he actually started trading with a humble beginning of just USD $500 when he was only 21. Okay, and within 2 years, he actually managed to turn it into a little fortune of 13,000 USD. All right, and because he was so successful at that young age, he was featured on Singapore's CNA, Channel News Asia Money Mind show called The Young Investor, and he was also awarded the most popular FX trainer in APAC, and also the top Forex analyst in Asia by WikiFX 2019. So basically, he has a wide range of accolades, as you can see from here, but I'm not going to go through one of them. And today, Kar Yong is actually financially independent through his trading and investing in the financial market. And him having gone through the financial struggles during the early stages of his life, he understands how many people are also suffering the same guilt and shame in self-worth. Hence, one of Kar Yong's mission here is to help people achieve the financial mastery and empower them to design the life that they truly desire. So having coached over hundreds of traders across Southeast Asia in navigating this complex financial market, he believes that anyone with the desire to do so can also succeed in trading. Now, without further ado, let us welcome our speaker for today, Mr. Kar Yong. Over to you.
All right, okay. Good afternoon, everyone. Thanks, Junki, for the sharing at the start. Okay, so we'll jump straight into today's content over here. I'll take another minute, just very quickly share a little bit more about myself. But of course, the structure here today is we'll go through the content over here, and then we'll have Q&A. Okay, and of course, as we are progressing throughout the sessions, you may have some questions that you would like to clarify. I would strongly suggest you can always put up your question into the Q&A box first, just in case later you may forget something. So once you put that question in, we'll be able to look back later on and of course answer as many questions as we can, okay, within the time constraint itself, of course. Okay, so yeah, I think very quick one about myself. I think more importantly is to really share with you that I think all of us would come into the financial market not immediately born as a trader or an investor. but all of us entered the financial market with zero knowledge, okay? And this is something that I strongly believe with the right mindset and of course with the right approach, anyone is able to actually see results, okay? So my journey started back in June 2012. Back then I was still in uni. I came across it, just through the internet, not really knowing what it is, and basically that itself set path to my entire career to today. Okay, and I just also want to highlight, of course, with back in 2012 all the way until today, a lot of things have changed, especially on social media, in terms of the information that you can actually get from online. You definitely need to do more filtering, right? Back in 2012 when I came across it, it's not so exaggerated, okay? But in today's context, you just need to be very, very careful on certain informations that you that can't receive from online, okay? And just take note of that, okay? So having said it, I'm actually quite active on social media, both on Facebook and Instagram. You'll be able to find me, but of course, just take note that there are also many fake accounts out there. Not only myself, but I think, if you're also quite active on social media, you actually might come across some fake accounts, trying to ask you for money and sort of, hey, just be very, very aware. Just want to highlight on this so that none of you would actually fall victim onto such of all the scams happening on social media, right? Whether it's Instagram, Facebook, or even sometimes Telegram, okay? So if you're active on there, just make sure if you like to follow some of my content, okay? My full name, my full username or URL on those social media account is my full name, right? Kar Yong itself, okay? So there's no dash, there's no underscore, there's no dot whatsoever, okay? Good. So with that cleared, hey, today's focus over here, I'll be sharing with you more into the various aspects of analysis, okay, towards the financial market. And then some of this example here will be a little bit more in relation to the currency and FX market, okay, especially on the fundamental aspect. So do take note of that as well, right? So today we'll be covering on fundamentals, we'll be talking on technicals, and then I'll talk a little bit about risk management. And the final part of today's sharing will kind of talk a little bit about how to craft and develop your personalized trading plan, right? What are some of the elements you need to put in, right? So why fundamentals, or why are there generally different types of analysis? The reason is because the financial market as a whole is very much interconnected, and there are many factors that's ongoing concurrently that can affect the prices of any particular asset or securities. And for that reason, you can't be only looking the financial market or analyzing the market from a single perspective, right? So that would be very, very myopic. So you need to have multiple prong of approach to decipher and kind of understand what's actually ongoing within the entire market and make the best decision that you can based on the analysis that you actually perform, okay? So fundamentals itself is one of the important aspects. Okay, and fundamentals over here, when we are talking about general financial market, it can range from a lot of things. But today over here, we'll be focusing a bit more for fundamentals in terms of FX, in terms of currencies, and therefore we'll be diving into a little bit more of a context and details of it. Okay, so fundamental flow, again, whenever I share this topic, some of the audience would say, oh, but I did not study economics, right? I have no economics background. How can I use it? Okay, do I need to spend a lot of time to study? Is it very, very difficult? To be honest, I did not study economics as well. In fact, I did not even study like finance, okay? But the important aspect is not really in, understanding every little detail within it, but at least as a trader, you want to know the gist of it, the big picture of it. Okay, so if I can break the whole topic about fundamental into something that is easy for you to digest, there are mainly three components that a trader needs to take note of. Okay, now whenever we talk about fundamental, you can't run away from central bank, okay, because every country would have a central bank, and the decision that the central bank make would directly impact the currency of the particular country or a particular nation. Okay, so you obviously need to understand a little bit about the central banks, right? What are some of the KPIs that they have? What are some of the mandates that they have? What are some of the tools that they can use to actually intervene into the economic performance of that particular country? Okay, and I strongly believe if you are kind of like following through for the past couple of years, since the COVID lockdown all the way until now, basically everything is being squeezed into a couple of years, where in the past, during normal circumstances, a lot of all these policy changes would take maybe about 5 to 7 years to see a cycle. But for the past 3 to 4 years, we kind of seen a full cycle in what the central banks are doing, right? So later, as we go deeper into the sharing, I want you to also start to relate, some of these things, how is it being applied in a real life context and what you are witnessing right now as well. Okay. Now, of course, when we talk about fundamental, we talk about economics. You will need to have some form of an indicator, right? So this is like your report card of a particular country. Is the economy doing well? Is the economy doing well? All these indicators would give clue to us as traders and as well as the central bank to help them make some policy decision, right? So this is something you need to take note of as well. And then as traders, you need to then interpret this information and make a decision on your trading. Okay. So let's talk about central banks, right? Of course, every country has a central bank. So over here, if you're trading the FX currency market, we generally trade the major currencies, and we have 8 in total, right? So we have the US dollar. The central bank of that is the Federal Reserve. Okay, in short, is the Fed, right? FED. Okay. Then of course the yen, we have the Bank of Japan. The pound, we have the Bank of England. The euro, we have the European Central Bank, in short ECB. The Swiss franc, we have the SNB, Swiss National Bank. New Zealand is RBNZ. Australia here is RBA, and then of course CAD is the Bank of Canada. Okay, so you just need to be familiar with some of the acronyms and the name of it, right? Because most time you would see traders communicate by saying like BOJ, right? So you just need to know BOJ stands for Bank of Japan, right? Right. So we are basically just taking the first letter of each, and then Bank of England is BOE, etc. Okay. So do take note of this, just general knowledge for you to know the names of what are the central banks. Okay, and the next part here is to understand the mandate, right? Mandate, if you're not familiar with this keyword, is basically KPI, right? KPI, I think you guys would know, key performance index. Okay, basically is their objective, right? They are striving to achieve something within the economy, right? That's their role as a central bank. So what are some of the mandates that they have? Number one is price stability, which ties into inflation rate. Okay. Now, obviously, for the past 1.5 years, this has been one of the primary concern, inflation, especially after the lockdown when things open up. A lot of prices shoot up. It brought inflation up. Okay, and this is a global concern, right? That's where a lot of banks right now are kind of fighting inflation. Okay, why? Is because when inflation is too high, it's not good for the economy. It's going to impact everything else. It's going to impact your export imports. It's going to impact the livelihood of your local people. Okay, and it's going to impact global everyone. Okay, so a high inflation rate is not good. Okay, a too slow inflation, or we'll say too low inflation, or the opposite of things, deflation, stagflation, it's also not great, right? Because it means that your particular country is not growing. Okay, whereas relative to other countries, if they're experiencing healthy growth, then it's a concern. Okay, so inflation too low is not great, means it's not growing. Too high is also not good, right? So you need to have a healthy inflation target. Now, for general knowledge, most developed countries would have a target of about 2 to 3% per year. Okay, so this is a long-term target, right? Which means short-term inflation may fluctuate up and down, but if you stretch it out throughout the year in the long-term target, each developed nation, their target for inflation is usually between 2 to 3%. So if something is below 2%, you know that the banks needs to do something. If the long-term inflation is above 3%, you also would know then the central bank would need to step in and take action. Okay, so that's something you need to be aware of, because as a trader, if the bank starts to intervene, they will do certain things. That's your opportunity to actually trade and profit from those price movement. Now, the other mandate is the labor market, right? Which is they would like to strive for full employment. And that's also important, right? I think that's quite straightforward. If general population in a country is unemployed, they can't get jobs, it's going to affect the economy, right? And the ideal here is, of course, everyone who wants to find job will be able to get it, right? So that's what we call full employment rate. Okay, so same thing, right? If the labor market is not performing, the central bank will need to step in to kind of help out a little bit, to make certain policies to help it, and that would also directly impact the price movement of certain currencies. Okay, so certain countries, right? For example, Singapore itself would have an additional mandate, such as the exchange rate policy. Okay, you guys would probably be familiar with that as well, where Singapore central bank's MAS, right, would have a bandwidth for the Singapore dollar to actually consistently grow. Again, the reason is because Singapore is very import oriented, okay, and a weak Singapore dollar is not going to benefit the country. Right? So certain currencies that is very reliant on import and export would have certain additional mandate to ensure that their country can continue to grow. Right? So take note of this, because every bank's decision would eventually come back to the mandate. Okay, so you understand what is their KPI, you understand what's their target, and you then understand where the current economic performance is. If there's a gap, what would the bank do, and how would that decision actually relate to a currency price movement, right? So that's your role as a trader. Okay, so over here, this is basic economics understanding. Okay, so if the economy is too strong, we're gonna get into hyperinflation where price just basically skyrocket. It's not good. If the economy is too weak, then we enter recession, which is also not great, right? So we want to always strive for a balance. Okay, so what are some of the tools that a central bank can actually use to ensure they achieve their target? There's not a lot, right? Generally, there are three. First is interest rate, okay, which in the past, again, 1.5 years, you probably observe and you see a lot of banks are actually hiking rates, right? Because generally, if the inflation is very high, okay, they will increase interest rate to stop people, or I would say to prevent overspending, right? To kind of like tell people, okay, right now interest rate is high. If you want to borrow money, it's going to be expensive, so don't spend so much, right? So that will actually lower spending, and when people spend less, demand drops. Demand drops, naturally prices will start to come down, right? So that's the natural chain of thought. Okay, and of course the opposite is true. If the economy is not doing well, they will start to lower interest rate. So you observe that during the COVID lockdown, all the banks starts to cut interest rate very, very quickly. And when that happens, it means that today, if you borrow money in a very low interest rate environment, it's cheap. People tend to spend a little bit more, right? And when they spend more, it increases demand, and therefore prices will start to go up. It will bring the entire economy back up, right? So that's interest rate in a nutshell. And then we have the easing policy, right? This one is a little bit more what we call monetary policy, where a central bank can decide to do this policy called quantitative easing, in short QE. We always relate that to like printing money. Okay, now of course, there is the action of really printing the money, but the whole process of it is where the central banks actually buy up government bonds from the government itself, and then through the process of buying government bonds, they need to pay the government, and therefore the government would have the additional quote unquote income, okay, from the central bank, and then the government would then be able to spend this money to help spur up the economy, right? So usually quantitative easing, or QE, is being deployed when the economy is not doing well and they want to inject money into the economy, right? The opposite of QE is what we call tightening, where the central bank may decide to slow down the printing of money, or in fact stop entirely. That will reduce the money supply, and again, in the basic understanding of demand and supply, if supply actually drops or supply doesn't increase, then naturally prices will go up, right? So that helps to kind of stop people from overspending as well, right? So these two tools are very, very common. Now the third one here is not so straightforward, okay, but it's also a very effective tool that central bank can use. We call it language, okay? So language basically means that as a president or chairman, chairperson of a central bank, they can release certain statement to inform the country, and the economy will then be affected by it. Okay, so just imagine a scenario where a chairperson or president of a central bank says that, economy outlook is terrible, we are not very positive about the future. These are certain things that we may consider doing. And when they release a statement like that, the market will immediately take action first, even before the central bank actually deploy those policies. The market will react first. Right? So language is actually a very, very effective tool for central banks, and therefore, as traders, we will also want to pay very, very close attention to what exactly these statements are. Okay, so you need to take note from a fundamental perspective, the three tools that central bank can do. Okay, so generally, what's the impact of a certain decision from central bank? How does it impact the currency market? Usually when they are raising rates, the currency would tend to strengthen, and of course the opposite is true. Okay, meaning if they're doing rate hike, they're doing tightening policies, the currency would tend to strengthen. Okay, think of it as a demand and supply equation. Okay, when central bank cut rates or they start to do QE, they print more money. Okay, then of course money is cheap, supply is increased, the currency will tend to weaken. Okay, so if you take a look at the dollar in particular, the US dollar, okay, for the past good 1.5 years, the Federal Reserve has been very aggressively hiking rates, right? And that's where we see the dollar strengthen relative to, general most of the currencies globally. Okay, so that's from a fundamental understanding. Okay, it's not like immediately it's gonna apply. It's not like immediately the currency is gonna strengthen, but we're talking about general direction. Okay, because fundamental, as I mentioned, is one perspective of looking at the market. There's still many other factors that can affect prices. Okay. Now, if a central bank decides to hold rates, then of course we need to dive a little bit deeper to go and understand, what's their next thing, what's their likelihood of, cutting or hiking in the future, what is their outlook, what is their expectation. Okay. So holding rates will be a little bit tricky in a way because it can go both direction, right? The bank can then say, okay, I'm going to increase in the future, or the bank can also say, I'm going to cut in the future. Also take note, central banks, they don't, shift their policy just, from month to month, right? Meaning the bank would not say, I'm going to increase rates this month, and then next month they're going to cut it, right? And then the following month they're going to increase, and then the following month they're going to cut it. They don't usually do that. Okay, so usually it's a sequence, right? When they're hiking, it will run through a process of hiking multiple times. And when they're cutting rates, they'll run through a process of cutting it, multiple times. Right? So you want to be also aware, like, from the Federal Reserve context, we have seen interest rate rise from near 0% to as high as somewhere around 5.5 at the moment. Okay. So we have increased drastically, right? From 0 to 5% is huge. So you can see for the past 1.5 years, they basically is in a hiking process. Okay, so eventually there's a good chance that the Fed will start cutting rates. Okay, and when they start to cut it, it's not going to be just one time, but it's likely going to be multiple times, maybe stretching across a good 1 year or even 2 years process. Okay, so that's something for you to take note as well. Now, this slide over here kind of summarize the entire fundamental cycle. Okay, so if you would like to, definitely you can take a photo of this, you can do a screenshot of this. Basically, you start from the top left and then you follow the arrow, and generally economy flows in this cycle. Okay, it repeats itself over and over again. So if you have a better economy, you have a good economy, everyone is being employed, spending will increase, that will lead to inflation. Okay, and when inflation starts to go up, central bank will be afraid of hyperinflation. They will start to take action. Okay, and the action that they're likely going to take is tightening and hiking rates. And then when they start to do that, people would spend more prudently, businesses will cut down on spending because money is more expensive now. And when they start to do that, the economy starts to slow down, and then it will then go back to the cycle of potentially a recession. and therefore the bank would then need to do the opposite. They'll need to cut interest rate, they need to do QE to encourage people to spend back again, right? So this is always a cycle, right? Most of the time, one full cycle is somewhere between 5 to 7 years, as I mentioned. But since COVID until today, this entire cycle has shrinked. Okay, so the life cycle of, the full cycle of it since COVID has been cut short to about 3 to 4 years. Okay, but it's still within the cycle itself, right? So you can also look at this from a perspective of understanding where we are right now. Okay, obviously right now we are at a high interest rate environment, so eventually the banks are going to cut rate and we're going to go back into this cycle where there's a fear of a recession. We'll go into cutting rates, we'll go into QE, and then certain currencies will therefore depreciate. Okay, so that's the cycle of it. Right, now in short, I also put this into a table format. Again, this is not 100% where when one thing happens, then the immediate effect is that the other would happen, right? No, this is, again, I just want to stress and highlight, it's just one factor impacting the market. Okay, so if we have a bad economy, this would be likely what the banks are going to do, and that will be the general effect of the currency. Okay, so if you study economy, you have this word called ceteris paribus, right? Which means that taking into account everything else remains constant, then yes, this will be the impact. Okay, but you need to understand the entire financial market is very dynamic. There are multiple factors affecting it at any single point of time, right? So this one here, you need to take into the context where everything else you ignore, then this would be how it impacts the market. All right. So pretty straightforward, right? Again, I want to stress and again give you the confidence in understanding fundamentals analysis doesn't need to be overcomplicated. Right? Yes, it does take time and experience, to practice, to put things into action, to understand a little bit deeper. But to get started, okay, it's really not that difficult. And hopefully, I give you a good understanding up to now what fundamental analysis is. Okay. So far, so good, yeah? So again, just want to remind, if you have any questions, feel free to put it into the chat box, because I would like to, do the Q&A at the very, very end so that, we can flow through and make sure everything is covered within the time itself. Okay, so that's the fundamental analysis process in a nutshell. Okay, now, next thing that we're going to jump in is technical analysis. Okay, so technical analysis is a very, very huge topic because there are many methods, there are many ways to analyze technical, right? Technical charts, basically we look at price movement based on charts. Is a study of price movement, and there are generally two big approach. One is what we call price action, meaning you study exactly what price is doing, you make a certain decision of it. And the other aspect is called technical indicator base, which means you rely more towards different form of indicators to help you make trading decision. Okay, now there's no right or wrong, there's no such thing as which is better or what's the best method, because every trader has a very different philosophy. Every trader would have different preference. Okay, the only way you're gonna find out what's best for you, for yourself, is to explore and try it out. Okay. Now, for me personally, I'm not a person who rely much on indicator, because my belief system, my philosophy to approach trading is when I'm looking at a chart, I would rather study the price movement as compared to the indicator, because at the end of the day, indicator is a derivative of price, which means whatever indicator you study into, it studies the price as well. Okay, that's how the formula is being kind of derived. So for me, my belief is, why not just study price directly? Okay, but of course it doesn't mean that indicator doesn't work. I know traders who use indicators and they actually can profit from it. Okay, so over here, today's technical approach that I'm going to share with you is going to be what we call a mechanical method. Okay, so the opposite of mechanical method is subjective, okay, or discretionary, right? So I believe that if today you are very, very new to technical analysis, it's always great to start off with a mechanical approach. Okay, mechanical approach meaning there is less element of being discretionary. There's less element of subjectivity. Okay, everything becomes very, very clear. Of course, we can't have 100% objectivity, but we try to do it as much as we can. Okay, so that's what we call mechanical. So as a new trader, okay, it's going to help you a lot because it takes a lot of guesswork out of it. Okay, and then of course as you progress, some of you may be more, I would say, you would prefer a little bit more on the discretionary aspect. Some of you would still prefer more in terms of like very objective approach of trading. Okay, again, if you think of it in terms of the context of your study, right? Some people love engineering, some people love arts. Okay, it's the same thing in trading, right? If today you love engineering, you probably lean towards being mechanical approach. Okay, if you're more arts kind of person, you probably lean towards a little bit more discretionary. Okay, so there's no right or wrong, there's no which one is better. You need to fit into your personal kind of like preference. Okay, but again, today we won't be able to go too wide, so we're gonna pick one. Okay, and we're gonna stick to that first. So today we're gonna talk a little bit about what we call structural trading. Okay, and I want to share with you some key definitions so that you understand it, and then we'll jump into the charts later on. Okay, so what is a bullish market structure, or what we call an uptrend, is basically when we have higher highs and higher lows, right? So right now, just understand it in terms of a key form, word form. Later, I'll bring you to the chart to illustrate all this, right? And of course, the opposite is a downtrend, where we say we have a bearish market structure. This is where we have a lower highs and lower low. Okay, so there are also this term here called break of structure. Okay, so BOS in short. Okay, what it means is that today we do not have an uptrend or we do not have a downtrend until the higher lows and the lower highs are being broken. Okay, so later in a while I'll also share with you in a chart, illustrate all this. But these are just key definitions that I just want you to understand first, right? In terms of like what we mean by bullish market structure, what is break of structure, or in short BOS, what are all this? Okay, and then after when we go into the chart, you can kind of remember a little bit better. Okay, then we also have the keyword called swing high, which is basically the highest point that caused the swing low. Okay, and of course we have swing low, which is the opposite, right? The lowest point that caused the swing high. Okay, and then of course we have break of structure, right, which is BOS. And then after a break of structure, we often expect a pullback. Okay, so understand that the market will not always move in one direction all the time, right? It will go up, it will come back down a little bit, it will continue to go higher, it will come back down a little bit, or it can come down and then pull back a little bit and then continue its way down and then pull back a little bit. Okay, that's how the market develops. Okay, it's never going to be all the way in one particular direction. It moves in swings, it moves in waves. Okay, and then we have the internal structure, which is basically the smaller perspective of the market. Okay, so with this, right, let me jump into the charts to very quickly illustrate this concept first. Okay, so it doesn't matter what instruments, what security you're looking. Again, it doesn't really matter what time frame. Okay, because the idea about technical analysis is that it is the same. Okay, the concept, the principle can be applied to any chart, any time frame. So this example that I'm going to pick is the chart on gold, right? XAU USD, and the particular time frame we're looking at right now is on a H1 chart. Okay, now I want you to take kind of like focus on certain aspect, right? So if you start from the top left, okay, you can very clearly see this is a high point, okay, after which the market starts to move lower. Okay, and then from there it forms a low, it starts to bounce a little bit to the upside. So this becomes our low point. Okay, so at this point here we have a high, okay, we have a low, the market did a pullback, and then it continues to come back down. And what you observe over here is the market price actually broke that low. Okay, so at this point in time, okay, this particular point in time where the market broke that low, we call this break of structure, BOS. Okay, so just now we have a definition where we say that we won't know this is a swing high until we get a break of structure. Okay, the reason is because if the market doesn't break this and it just continue to go higher and breaks that high, then this is no longer a swing high. Okay, so we only can say this here is a swing high when the market break a structure, right? Break a structure basically means it needs to break below that previous low or high, and it needs to close below it. Okay, so what you see here is we have a swing high, we have a swing low. Because price broke that swing low, this becomes our swing high, and then the market continued down all the way until it comes back up over here. Okay, so when it starts to pull back up, okay, and it continues to go lower, we start to observe another break of structure here. Okay, when the market starts to close below this low, we have a break of structure, so we know this point here becomes our swing high. Okay, so we can't establish this swing high until we get a break of structure. Can follow that top process, right? Because if the market doesn't break this structure, we never know this is going to be the highest point. Okay, because the market can go higher, and this here will not be the highest point. Okay, so we need to have a break of structure before we can determine certain points. Now, just from here, you can see we have a high, we have a low, we have a lower high, we have a lower low, we have a lower high, right? So what is this? This is a series of lower highs and lower low, and therefore this is a bearish market structure. Can follow the top process. Okay, so this is actually a downtrend in this particular time frame. Now, just now we also mentioned, right? Every time we get a break of structure, we expect the market to pull back. Okay, so you can see here, right? It broke that structure, it pulls back. What happened? The next move, it went down, it broke that structure. Okay, and then what it does, it pulls back. Okay, so this becomes your swing low, and then at this point in time here, we get another break of structure. Okay, and then we know that this is a swing high. We get a break of structure, it goes lower. Okay, so all the way until here, it gets another break of structure, so we get another swing high. Okay, so this is bearish market, and you can see the definition of break of structure: swing high, swing low, swing high, swing low, right? Okay, so this is an example of this. Okay, so all this here you can see, right? Now, what is internal structure? Internal structure is the internal moves within this entire piece. So we have the bigger move, right? So high, low, high, low, high, low, high, low. But if you zoom in a little bit, okay, let me just clean up everything first. Okay, now if you zoom in a little bit, you can see here internally we have one up move, one down move, and then one up move, right? So this is what we call an internal structure. Okay, so some internal structure are clearer, like this here as well: down move, up move, down move, okay, and then an up move. So these are all internal structure. Okay, so you have the bigger move, okay, and then that's what we call swing moves, and then you have the internal structure, which is the inside, okay, the smaller pieces of things. Okay. So that's how mechanically we can actually define a bearish market structure or a bullish market structure. Okay, so this one here is an example of a bearish one. Okay, so the market is coming down. Yeah, so in a while we'll show you a little bit more of an illustration over here as well. Okay, so this one here is, just now I show you on a chart, right? But this is basically an illustration, okay, in drawing. Okay, so you can see over here, right, from swing low, it moved to develop a high, okay, and then it came back down, develop a low. Okay, let me just take out my pen, right? So over here, right, we have this, sorry, let me change the color as well. Okay, so over here, we have starting low, right, which means you assume the price came down, it established a low, it went up, it came back down. We never know this is a high and this is a low until we get a break of structure. So once we get a break of structure, we know this is a high, this is a low, and then we have a higher high and a higher low, right? Because this here is our starting low. Okay, so this is a high, this is a higher low, and then once we start to break of structure, we'll naturally already have a higher high. It's just that we haven't know where the higher high is, but we already have a higher high once we get a break of structure. Okay, so at that point in time, we can say that we are already in an uptrend because we have a higher low and a higher high. Okay, and of course, After a break of structure, what do we expect? We expect the market to pull back. And then when we get a break of structure here, we know this is a low point. Okay, so this is an uptrend because we have a high and high low. This is a downtrend, which is the same principle. Okay, so this is where you need to be very clear in a definition of what is break of structure, what is a high low, right? So break of structure is basically the candle closing below this in terms of a downtrend, and break of structure in an uptrend, basically the candle need to close above this, right? It cannot be just poke it and then come back down. Okay, it needs to close above or below. Okay, so now before some of you get confused what is close, what is not, okay, let's come back to this chart over here. Okay, I'll zoom in a little bit. Now, if I'm gonna take this low point here, right? So I want you to see, right? So this one here, you can see the candle actually went down, but that's just the wick. It's just a line. Okay, the body of the candle did not close below it. Okay, until we move all the way until here, then yes, you can see this candle closes below that. Okay, so over here at this point in time, okay, this candle is not a break of structure because it did not close below the previous low, but only here did we get a break of structure. Okay, so that's what we mean by the candle need to close below it. Okay, same thing over here. Okay, same thing over here. Okay, if you stretch all the way here, now this tests the low, but it did not close below all the way until this candle, it closes below, right? So that's a break of structure at this point in time, but not here. Okay, so this is the definition of it, right? So you want to be very, very precise to make it very mechanical. Yeah, so that's the first understanding of structural trading. Okay, how do you define break of structure? How do you define uptrend or downtrend? Now, as you are able to understand that, okay, the next step in the technical analysis for this approach is to understand where are the strong highs and where are the weak highs, or where are the strong lows and where are the weak lows. Okay, so what we mean by strong or weak is basically if today we are in an uptrend, okay, it means that the lows are stronger compared to the highs. Okay, why? Because the market is continuously going higher and higher and higher. It tells us that the low points have a lot of bias coming in, and therefore it's strong. Okay, the highs gets broken all the time because we're in an uptrend. It means that the people at the high trying to sell are weak. Okay, so that's what it means. Okay, so strong lows are lows that cause a new high. Okay, and strong highs are highs that cause a new low. Okay, and the opposite is true, right? Basically, if you have weak highs or weak low means they get taken out. Okay, so if you put this in the understanding of demand and supply, demand being buyers are interested in it, supply meaning sellers are interested in it. So if we have strong lows, okay, that causes price to go higher, it means that there are a lot of buyers pushing price up, okay, which means the demand is strong. If you have a strong high pushing prices down and causes a new low, it means that people are selling aggressively, and it tells you that supply is very strong. Okay, so that's the understanding of what we mean by strong high, kind of strong highs and lows versus weak high and low. Okay, so your goal as a trader is once you establish if the market is in a bullish market structure, which means we're in an uptrend, you want to identify where are the strong lows to get involved in trade, and your take profit, your targets are going to be those weaker highs. Okay, because we are uptrend, you want to be joining the bias, you want to be joining the demand side of things. If the market is in a downtrend, you want to be focusing on selling because that's where the strong sellers are. Okay, now give you some illustration as well. Okay, if you're in an uptrend, the lows are the one that you want to keep an eye on because those are the strong lows, okay, that causes a break of structure. and the yellow highs are the weak ones, okay, and they tend to get broken because they are weak relative to the low. Okay, if the market is coming down, the highs are the one that are strong, okay, supply are strong, and the low tends to be taken out because they are the weaker lows, right? So that's the concept in understanding between demand and supply. Okay, now we always have this phrase, right? Stick to the trend, follow the trend until it shifts, right? Or you heard of this phrase, the trend is your friend, okay, until it changes, right? So from a technical analysis, how do we know whether the trend is gonna shift or a trend is likely gonna be completed soon? Okay, so we have this thing called the change of character. Okay, the definition of it is CHOCH, right? Change of character, right? So we will say that a trend is likely to change when the order flow fails. Okay, so basically means that in a bullish trend, the expectation is that price will continue to make higher highs and higher low. In a bearish trend, we expect price to make lower low, lower highs. So if either of this starts to fail, we then need to be aware that the trend would likely be shifting soon. Okay, and this is something where a bullish trend change or bullish trend shift is confirmed once the price break a swing lower high to form a swing higher high, right? So in a while, I'll show you some illustration in a chart as well so they understand this, right? Basically, bullish and bearish, they're the opposite of things. Okay, so this is an illustration first, right? So initially, you can see from the left, okay, we have a series of higher high, higher low, higher high, higher low, higher high. All this while the market is in an uptrend until the market starts to come back down and it takes out this low. So we get a break of structure. Now at this point in time, okay, all this have yet to happen, yeah? Okay, just take note of that. At this point in time, we identify that, okay, this is a potential trend shift. We technically do not have a downtrend yet because we don't have a lower low or lower high. We only have a higher high and then we have a higher low. Sorry, we have a lower low. That's all. Okay, this point hasn't been established yet. So at this point, we only have a break of structure. We have a warning that the trend is shifting, but we do not have a bearish trend yet. So usually at this point in time as a trader, you do not want to be buying yet, but doesn't mean you want to be selling, okay, because we don't have a downtrend. Until what the market did over here is we form a high and we get a move down and a break of structure here, so we know this is a lower high. At this point in time, yes, we have a bearish trend. Okay, then after that, the market forms a low. It did not continue going lower. It takes out the previous high. We get another break of structure. We have a trend shift here as well. Okay, and then after which we had this and we are back into an uptrend. Okay, so of course this is not going to be the most ideal environment to be trading, but I just want to illustrate, from a bullish trend shifting into a bearish trend and then shifting back up into a bullish trend. Okay, so you realize that we are very, very objective in defining things. Okay, we don't say, oh, this looks like an uptrend, this looks like a downtrend. We take away the subjectivity, right? We want to be as objective as we can, right? As mechanical as we can. So let's jump into a little bit of a chart over here. Okay. Yeah, so let me clear this off. Let's move to a higher time frame. Okay, to look at things a little bit different. Okay. So today, if I look at this on a daily scale, right, I would see things very differently, right? Just now we're looking at the downtrend on the lower time frame on the H1, but if today you go on the bigger time frame, things look slightly different. Okay. So let's start working, at picking a very obvious low. Okay, so what happened here? The market went up. Okay, it did a pullback. We get a break of structure over here. Okay, break and close above, and then the market puts in a new high. Okay, so at this point we have a higher high, higher low. So what happens is this would then be established our swing low. Okay, so we get a break of structure. Okay, the lowest point that causes the break of structure is our swing low. Okay, and it starts to pull back. This becomes our swing high. Okay, and you can see over here, this is where we get another break of structure. Okay, so the lowest point that causes this break of structure is our swing low. So where's the lowest point that causes this break of structure? Is here. Okay, is this low? So this low becomes our swing low. Can follow the top process, yeah? So the market continue to go higher and then it starts to pull back. Okay, so at this point, this high becomes our swing high, and this remains our swing low. Okay, now at this point in time, what do you think the market structure is? Okay, even though this starts to pull back, you realize one thing. Did the market take out this swing low at this moment? The answer is no. Okay, so from this perspective, from this time frame, we are technically still in an uptrend. We are in the bullish market structure because this swing low remains intact, and this here we're experiencing this is just an internal pullback. Okay, now suppose the market keep dropping and it breaks below this structure, then yes, we may get a trend shift. But until then, this pullback here is just an internal move. Okay, so those are the definitions you need to be very clear. Okay, so internal structure, yes, we get a swing low, a swing high. We did not get a break and close below this level yet. Okay, so at this point in time, we don't even have a bearish internal structure. Okay, so we have a bullish swing structure. The larger time frame, we're bullish onto that because this swing low is still intact. Okay, and this swing low is a strong low, meaning our trade direction we want to focus is buy trade opportunity. Okay, we're not so interested in the sell based on this perspective. Okay, of course you can play around with multiple time frame, but I just want to make sure you guys understand the principle of it, the definition of things. Okay. Again, I can pick up another chart just to work on different example. Let's take euro dollar, which is one of the most. Give me a while. Let me identify. I'll just type this in, yeah. Okay, euro dollar, right? So let's play around with maybe a slightly different time frame. Okay, so let's take a look at the smaller scale. Okay, let's say we apply this on the 15-minute chart, right? So we always pick an obvious high and low within your chart to start off, right? So we have this low here. The market went up, it came back down. So we have this high, and you can see we get the break of structure. Basically, the price breaks and closes above this high. So then we know this is a swing low, right? So this swing low so far hasn't been taken out yet. Okay, and of course, after a break of structure, we have this high. So we have a series of high, 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 low. Okay, so on this scale, on the 15-minute chart, we're technically in a bullish market structure, which means you'll be interested in looking for buy. Okay, and this area, okay, is what we call a strong low because this low has taken out the previous swing high, right? So this is a strong low. So if I can follow, right? So it's a very, very clear mechanical way of defining whether we are in a bullish trend or a bearish trend. Okay, so that's the aspect of things, right? And then let's talk a little bit about internal structure. Okay, so internal structure are all the structure between the swing high and the swing low. And just now I mentioned about this thing called change of character, right? Change of character is when an internal bullish structure change into bearish or vice versa, which means from a bearish internal structure it changed into bullish. Okay, so I'll share with you the illustration of things so that I understand a little bit. Okay, but in terms of words, a definition of a bearish change of character is when the first internal low is formed, okay, after a series of higher lows, right? So basically the market turns bearish. Bullish change of character is when the market change bullish. Okay. Yeah, so this is the illustration of it first, right? So you can see the market is coming down, right? We have a series of lower low, lower high, lower low, lower high. And then at this point in time, we start to shift, right? This high here gets taken out. So at this point in time, we have a bearish trend turns bullish. Okay, and then the internals continue to move higher, move higher, move higher, and then at this point in time, when we get a break of structure here, the internal starts to turn back bearish. Now, this one here is what we call internal because we're looking at a smaller scale. From a larger time frame perspective, we'll see this as one major swing. This is a pullback, and this is another major swing. Okay, so from a larger time frame, okay, so let's say we have a H4 chart. In red, okay, that's your bearish trend. Okay, in white is your internal, maybe that's the H1. Okay, so in the white, as this is going up, okay, what we have is 4-hour structure is still bearish. The white internal structure as it's going up is just simply a pullback. Okay, so you need to be very clear in terms of the definition of what is an uptrend and what is a bearish trend, okay, because that's going to kind of determine the direction that you want to focus for trade. If you're in a bearish market structure, any pullback is actually a sell opportunity. If you're in a bullish structure, any pullback to the downside, okay, let me draw it out. If you are in a bullish structure, any pullback that you see is a buy opportunity. If you're in a bearish structure, any pullback is a sell opportunity. Okay, so that's why it's important to establish what the market structure is so that you can determine whether you focus on buy or focus on sell. Okay, so change of character, right? Is actually a useful signal that a swing may be finished and a pullback is starting. Okay, so meaning, it gives you some sense of timing. Do not rush into certain trades. If you start to see change of character, a pullback may be happening. So be patient, wait for the pullback to complete before you jump into a trade. Okay, so a change of character can also illustrate that a pullback may be finished and it's ready to develop the next swing, and therefore you want to be ready to take the trade. Okay, so in simpler terms, right, change of character is basically telling you turning points. Okay, that the market is likely to turn. You either want to be patient and wait for the pullback, or the market is turning, is starting to continue its trend, and it's time for you to ride on it. Okay, but of course, nothing is perfect in the market, right? Sometimes it can give you false signal as well. Okay, so examples of this, right? So let's put things a little bit together. Now, we have a low, we have a high, the market pulls back, okay, we get a break of structure, so this is our swing low, okay, and the market continue all the way up, and then we get an internal swing down, and then a push back up, okay, and then what we observe is the market starts to break this internal low, okay. That's when we know we have a change of character and the pullback is starting. What it means is that we have an uptrend, right? Up to this point, we have an uptrend, but don't buy here. Why? Because the pullback is happening. If you buy here, you need to experience the drawdown. It's not easy, okay? So when only should you be focusing on a buy? Because this is our swing low, okay? As long as the market price remains above this, we are looking at buy trade because we're in a bullish market structure. But this change of character tells you that the internals are bearish, don't buy yet, okay? And of course, the internals continue to be bearish until this break of structure here. Okay, at this point, you know that this pullback may have completed. Price is still above this strong low. We are still in the bullish trend. We get a break of structure, change of character here. This suggests that, okay, the pullback may be completed. Let's get ready for a buy. Okay, and that's where this entire pullback is your opportunity to get involved in the buy trade. Where would you put your target? Swing high, which is weak. This is strong low. This is weak high. Okay, so your target would then be here, previous high. Okay, so this is your opportunity to trade. Okay, so again, it's a very mechanical approach, right? There's no guesswork to it. This entire process here is an uptrend because this swing low hasn't been taken out. Okay, so we focus on the buy. Yeah, so I hope that gives you a little bit more understanding of all those change of character idea. Okay, this one here, is basically just telling you, giving you the understanding that change of character is not 100% all the time, right? Sometimes it can give you a little bit of a false signal, right? So this illustration says that, right? So look at this here. This one here, we have an uptrend, right? Okay, all the way until here, where we get a change of character, it means that a pullback is starting. Okay, so until this swing low is taken out, we are still bullish. But this change of character is not just signaling a pullback, but we end up getting a break of structure. So the market structure actually changed from bullish in this case to bearish. Okay, so obviously we did not also get a confirmation of a change of character here. So you do not want to be just buying off when the price is coming down, right? You need to wait for another change of character before you get involved in the buy. Okay, so this is an illustration where change of character can lead, okay, potentially into a change in an overall trend as well. Okay, so let's come back to a little bit of a chart over here. Okay, we'll pick this. I'll pick gold, right? Pick gold. Because gold recently has very nice little structural movement that we can really talk about. Let me go back to where we are right now. Okay, so let me clear things off. Okay, good. So now let's give you an example of how this is being applied, right? So this part here, we can see very clearly we have a break of structure, right? The price actually closed. I'll just zoom in a little bit. The price actually closed below that swing low. Okay, so where's the highest point that causes the break of structure? Is actually here. Okay, this high, right? So that high would become my swing high. Okay, and this is actually a strong high, right? Which means as long as price has yet to have not break above this high, we're technically in a bearish market structure, right? Because we have a lower high, lower low, lower high, lower low. Okay, so at this point in time, you can see that we are pulling back. Okay, so you don't sell immediately. We have a general sense of direction to sell because we're in bearish market structure, but we don't want to sell it now. Okay, so ideally what we want to see is for the market to continue to do a little bit more an up move. Okay, and if we start to get a change of character, okay, so let me string this a little bit. This is an internal swing low, right? So you can see the market move up, it pulls a little bit, and if it continues to go back up, and let's say at one point in time this comes down and break this internal low. Okay, so that's what we call a change in character in the internal. When that happens, it opens up the possibility for any pullback that's experiencing within this zone. Okay, suppose the market then after that do a little bit of pullback. Any opportunity of a pullback here is your sell trade setup. Okay, meaning you can look for sell opportunity, okay, within this area. As long as price is below that swing low, that's your opportunity to sell. Where would you expect the market to go towards? Weak low, which is the previous low over here. Okay, so that's something that you can look to apply. Okay, hopefully that gives you a little bit more of a understanding. But again, you need to definitely practice onto that, right? Okay, so that's on the technical aspect of things, right? There are definitely more steps to progress into. There are definitely more details, okay? But again, today's objective is to kind of give you guys the introduction to it, right? So that you can kickstart in application aspect, okay? Now, next, I'll very quickly jump into risk management, okay? And then we'll do a little bit of I want to also ensure that we have sufficient time to run the Q&A. Okay, yeah, so let's talk about risk management over here. Now, there are some terms that you need to be very familiar in terms of risk management. Okay, first off is what exactly is margin? Okay, what is leverage? There's a lot of misunderstanding about leverage. We'll talk a little bit about that. You need to know what margin level means to you. Okay, and last but not least, the term on drawdown. Okay, what exactly it means. So let's talk about margin trading. Okay, margin trading is essentially the understanding where in today's context, you don't need a huge capital in order for you to get started in trading. Okay, you can use a small capital as a potential collateral where you put, your deposit with a broker, and then that allows you to actually access a bigger position size. Okay, so this is the part where it will tie into the understanding of leverage. Okay, so when you hear people talk about margin trading, basically if today you trade CFDs, you trade stocks in CFDs format, right? You trade commodities in CFD format, or you trade FX market, you're basically doing margin trading, right? Because you are naturally already leveraging a position through the broker. Okay, and this is an advantage because in the past, if you don't have margin trading, you don't have leverage, you need a huge capital for you to get started. But today, with an amount of like maybe in SGD, right, 500 SGD, 1000 SGD, you can get started, right? Because you have access to margin trading. Okay, and margin trading ties back to leverage, and this is a very, very commonly misunderstood term. Okay, because you either might come across traders who say, well, high leverage is bad, okay? Or you might come across traders who would have the understanding that the higher the leverage, the better it is, okay? Those are not entirely true, okay? Higher leverage does not equal to definitely being a better option, and opposite, right? High leverage doesn't also means that it's dangerous, okay? I need you to understand that leverage is essentially a tool. Okay, so how you utilize leverage is gonna either make it dangerous or helpful to you, right? So you can actually use leverage to your advantage. You can also use leverage to harm yourself. Okay, so you need to really understand what exactly that is. Okay, so leverage itself, if you know how to manage risk, you can use it more of an advantage, right? Because you know how to calculate your risk, you know how to calculate your position size. You will never maximize your leverage at any single point in time. But you know that, okay, when there's a golden opportunity, you are willing to take a higher risk, and you know that you have leverage, that's where you can utilize it to your advantage. Okay, so over here, let me give you a better understanding about what exactly it means. Okay, so leverage often comes in various, multiple times, right? Like 50 times, 100 times, 200 times, etc. Okay, and what does this mean to you is that if today, let's take a very nice number to work with, right? So let's say we have 100 leverage. It means that if today you want to execute a $10,000 position, you don't need $10,000 in capital. Okay, because you have 100 leverage, you divide 10,000 by 100, you only need $100 to actually execute this trade. Because what you need is just the margin to execute that, which is the $100, right? So this $100 is what we call a margin. It's basically the collateral that you lock in to execute this position size, right? So that's how leverage works. Okay, so if you have a 50 leverage, then of course you need a bigger capital. If you have higher leverage, then you need a smaller capital. Now this is where traders would say then the bigger the leverage, the better it is, because then I don't need a lot of capital, right? Not entirely true, right? Because you don't max out your margin every time you open a position. You need to still calculate what's the optimum size based on your risk, okay? So higher leverage doesn't mean you all is better, right? It just means that if today you have a very solid opportunity and you want to go big, meaning you're willing to take a higher risk, then yes, a higher leverage allows you to do that with a smaller capital. But from typical day-to-day trading, it doesn't really affect you much. Okay, so for example, if today I want to execute a 0.01 lot, which is the smallest lot size in trading, that's equivalent to 1,000 units. And if you convert that to a dollar, it's basically about $1,000. Okay, so with 100 leverage, I only need $10 to open and maintain that position. Okay, obviously it doesn't mean that you only put in a $10 account. Okay, but the idea is if today I put in a $1,000 capital into my trading account and I open this position, okay, I will need to lock in $10 to maintain and open this position, which means if I have $1,000 in capital, I would left with $990 of margin that I can use, okay, because $10 is being locked in for this position. Okay, so that's basically what it means, yeah. So this is also termed as margin required. Okay, so the $10 is basically the margin that you need. Okay. Now, that will then translate to the next term here called margin level. Margin level is actually a very, very straightforward way to assess the health level of your particular trading account. Okay, so whether your account is safe or not, right? So it's like you go to a medical checkup and then you get a report card. Most of the time, first thing you see is like your cholesterol level, for example, right? So margin level is a very quick way to assess whether your account, your trading account, is too risky, okay, or is still safe. Okay, there's a formula to it. You don't need to manually calculate it because the platform will actually calculate for you. But if you are looking at understanding what's the formula, is basically taking your equity over the margin that is used, meaning how much margin you use to open trades, you multiply it by 100%. Okay, so the higher your margin level, the safer your account is. And I'll give you an example over here. Let's say your capital is at 1,000, okay, and let's say you open some trades, but that trade is still at break even. There's no win, there's no loss, so the trade is basically zero net profit, zero net loss. Okay, so your equity is also at 1,000. And let's say you open a trade and you use up a margin of $10. Okay, so the formula to calculate a margin level is basically your equity, which is 1,000 over $10 multiplied by 100, and then express it in percentage. So that's a 10,000 margin level, which is very safe. Okay, so if you have a total trade margin of 500, okay, and assuming your equity is still at 1,000, then you realize your margin level drops to 200%. Okay, so obviously 200% is way riskier than 10,000%, right? Okay, so margin level, the lower it is, the more dangerous it is. Okay, the higher your margin level, the safer your account is. Now, this will then tie into this term called margin call, which means that today, if you don't control your risk, you take a lot of trades and your margin level starts to drop to a certain level, you will potentially get margin call, right? Margin call means that when your margin level drops below a certain level, the broker will automatically start to close off the biggest losing trade for you to ensure that you have sufficient margin to maintain the other trades. Okay, and of course, if those trades are also losing and you don't have sufficient margin again, it will keep closing your next big losing trade. This is to ensure that number one, you don't go into negative balance, and number two, to protect the broker as well, because if today you go into negative balance, you probably not pay back the broker, right? And the broker knows it, and therefore they will want to make sure that they have a system to ensure you don't go into negative territory. Okay, so give you an example, right? If today you have 4 trades running, one is losing $100, the next trade is making $40, another trade is making $15 in profit, and there's one trade you're losing about $230, and you hit margin call. Now, let's say your capital is very, very small, you can't some kind hit margin call. The broker will close off the dollar cap trade for you automatically to free up margin to hold on to the rest of the trade. Okay, normally, if you manage your risk well, this will not happen, right? This only happens if traders take too many trades, take too big position trades, and they don't have a cut loss point. Okay, so their floating equity keeps dropping until they do not have sufficient margin to hold on to the trades. They'll get margin call. Okay, so some margin level as guidance. If today you have a 5,000% and above, you are considered very, very, very safe. Okay, if your margin level starts to drop below 1,000, is something that you want to take note of. And if your margin percentage drops below 500, you're basically quite risky of being margin call. Okay, so do take note. Usually, give a good glance to this, you'll be able to understand whether is it high risk or low risk. Okay. Now, next term here, very quick one, is drawdown. Okay, drawdown is basically a measurement of how much money you have lost compared to the highest equity that you actually achieve. Okay, so it's often a measurement of risk as well, right? For example, if your highest capital or equity is 10,000 and your current account right now is trading at 8,000, meaning you suffer about 2,000 loss, right? So you express that in percentage, 2,000 out of 10,000, that's a 20% loss. Okay, so your drawdown is considered a 20% drawdown. Okay, so often this is an assessment of risk, right? You always ask, what is your risk tolerance? How much are you willing to risk? how comfortable are you in losing, right? So some traders are comfortable losing a big chunk of it, okay? So they might say, I'm comfortable losing 50%, so their drawdown is going to be 50% comfort level. Some traders will say, I'm very, very conservative. I'm only willing to accept, a drawdown of 10%. Okay, so that's what it means, right? You need to understand what it means by drawdown. Okay, so yeah, so as I mentioned, right, the term maximum drawdown is often used to decide what's your maximum loss, and generally, based on my experience, most traders are comfortable up to 20%. Okay, anything beyond 20%, they would be affected psychologically. Okay, they may say that, nah, I'm okay with 50%, but most of the time after 20%, they'll be affected psychologically, right? And as a trader, psychology is also very important. Okay, because if today you're not trading at your optimum state, meaning your psychology is not strong, okay, you're being affected emotionally because of some things, or even your trades are affecting you emotionally, you're prone to making more mistakes, right? So that's also something you need to take note of. Okay. Now, with all that said, right, I think today is definitely very heavy in content, but I just want to give you that kind of like overarching pieces so that you at least have all these basic foundations to help you in your in this competition itself, right? So good. So over here you need to develop your trading plan, right? So I'm gonna list down some steps over here. We talk about risk a little bit over here, right? So in terms of like drawdown and things like that, you need to identify your risk profile. Okay. Of course, as a virtual bootcamp competition, you're likely going to be a little bit more aggressive. Okay. But if you're eventually going to trade your individual account, you may need to think about this seriously. Okay. Then of course you need to establish your analysis and strategy, right? So today we can introduce to you guys a little bit on the fundamental aspect, a little bit on the technical aspect. You need to be clear, what's your approach, what's your method of analysis, what's your method of execution, and then you need to decide your risk management approach, right? How much percentage should you be risking every time you take a trade? If you're more aggressive, you may go up to maybe like 5% per trade. If you're more conservative, maybe about 1% per trade. Okay, meaning at worst case scenario, when you lose that trade, you lose 1% or you lose 5%. Okay, so that's generally the range. Okay, there's no right or wrong. You need to identify your profile first. Okay, then obviously you need to track and journal, right? Because if today you want to review it, you want to improve in your process of things, you need to have some data points to work with. Okay, so for example, okay, in terms of the steps to take, okay, every time you execute a trade, you need to first identify the direction to focus. Okay, so you can come from fundamental, you can come from technical, and of course the next thing is the best time to execute, right? You don't only need the direction, you also need the timing. Okay, so just now we walked through the fundamentals to give you the big picture. That's generally the direction. Then we look at the technicals, right, to define whether we are in the bullish market structure or bearish market structure. That's also the direction. Okay. Then we did talk a little bit about the concept of change of character to tell you that, oh, potentially, the pullback is starting, potentially the pullback is ending. That's giving you the time element to execute your trade, right? Is it the optimum time to start looking for entry? Okay, so those are the time element. And you need to then also, of course, manage your risk because you're not going to be 100% right all the time. You're going to take losses. Okay, so you need to ensure that whenever you take losses, you're well managing the downside and you're profiting when you're right. Okay, so that's about management of risk and then journaling. Okay, so whatever technique, whatever strategy you do in trading, at the end of the day, these are the elements you need to get it right. You need to get the direction right. You need to get the optimum time to get in and get out. Okay, you need to manage your downside, and of course, you just need to journal and track to build up the confidence in your method. That's the psychology aspect as well. Okay, so these are the elements that are very, very important in whatever technique and approaches that you use in trading. Okay, so give you some kind of like pros and cons, right? So fundamental here is great for understanding the overall market. Okay, it can serve as a directional focus whether to be buying or selling based on what the central banks are doing in general. But it's weak at telling you when's the best time, right? Because fundamental is a little bit on the longer term approach. Okay, So fundamental is good in giving you a bird's eye view, right? An overarching direction that you can focus, but it lacks the precision in terms of timing. Okay. So technical, on the other hand, is great in details, right? And it can give you precision timing to execute, which price to execute, which price to cut your loss, which price to target, take profits. Technical is great in that. Okay, and of course, technical can give you a direction as well. The challenge in technical analysis is the complexity of it, because there are just so many things that you can really go into for technical analysis. The not so good thing is you can really confuse yourself if you try to overcomplicate the entire process. Okay, so each method will have its strength and weaknesses, right? So just take note of that. Yeah, so that's basically about the analysis part, right? So risk management, the steps to do that is you always want to establish where you're going to enter, where's your stop loss, meaning where you're going to cut your trade if you're wrong. Okay, then you want to calculate the ideal position size, okay, based on where you enter, where you're going to get out, what's the sizing you need to enter to ensure that even if you're wrong, it remains within the risk tolerance that you are comfortable with. Okay, so you need to understand a little bit of pips. So of course, in terms of specific currencies, we look at the fourth decimal place as 1 pip. If it's a Japanese yen, we look at the second decimal place. Okay, and that translates to also lot size. Okay, if you trade 0.01 lot, generally on average, 1 pip is about 10 cents, right? So that's how you do a quick calculation, right? If your stop loss is 10 pips, if you trade the smallest lot size, then your risk is $1, okay, which is fairly small, right? So then they say, okay, if my stop loss is 10 pips, I can go a little bit bigger in my position size because I'm willing to risk a little bit more, right? So if you trade 0.1 lot, 1 pip is equivalent to about $1, and if you trade 1 lot, a pip on average is equivalent to about $10, right? So this is simple mental calculation that you can do. Okay, based on your stop loss. If your stop loss, as I mentioned, if 20 pips, right, then you can back calculate. Okay, I think you guys should be good with math as well, right? You just do a little bit of algebra, right? Let X be this, and then you're going to calculate it. Okay. So give you an example, right? If you're trading euro dollar with a stop loss of 100 pips, so I calculate and I decided my entry is here, my stop loss is there, and the width of my stop loss is 100 pips, okay, and I'm willing to risk $100, then based on this calculation, the sizing cannot exceed 0.1, okay, because if I go bigger than 0.1 lot and I hit my stop loss, then I'll be risking more than $100, okay, so that's the idea of it. So 0.1 lot, 1 pip is $1, and therefore if I'm risking 100 pips with this lot size, I'm risking $100. So far so good, huh? Okay. Yeah, so this is again a illustration to give you an understanding of what are some of the elements to put in your trading. Okay, so you can see the foundation below it is basically your mindset, your psychology, and your mentality to approach trading. The top is what we call the pillars of trading. Okay, you have the fundamental macro perspective, you have the sentiment analysis, which sadly today we do not have the time to go a little bit into that. Then we have the technical pillar. Okay, and then of course you have the risk management pillar. So you have these 4 pillars to build in your strategy. Okay, so that's the illustration that I often use to kind of illustrate, okay, what needs to go into your trading plan. Okay, so I think that's my last slide. We'll proceed into Q&A. Okay, so let's see some of the questions over here that we have. Okay, good. Okay, so I see a couple of questions. Some of them are answered. Okay, so I'll just scroll through the first one. Okay, I think I see a question from Enzer, right? Enzer asks, do I have a LinkedIn? Yes, you can find me on LinkedIn as well. Just search my full name, Kar Yong, you'll be able to find it. The next question I see also from Enzer, which financial instrument do I trade when I first started my journey? It was FX. Okay. Yeah, so a lot of people started with stocks and such, but for me, I start with the FX market. Okay. Benzer also asks, is strong low equals support? Yes. Okay, so you can also use terms like support and resistance. To me, the name the terminology is not the most important, but I think as long as you understand the principle behind it, right, I think that's the key. Okay, so strong low, yes, that's equivalent to support. Okay, Bradley here asks, when we look at varying periods of market structure, a term that comes up often is consolidation. I would like to know how, from a technical perspective, would you define it? Okay, now consolidation itself is basically a general description when the market is not giving you an obvious trend, right? So of course, in gold we don't really see that. But let's pick an example over here in a smaller time frame. Okay, so at this moment, right, this particular instrument, you can see we have this high, okay, and of course we have this low point here, right? So at this moment, what the market is doing is essentially trading between a swing low and a swing high. Okay, so this phase of the market is what we call a consolidation. Okay, so there is no clear direction if you just focus on this in this area here, because we only have a swing high, we have a swing low, and that's it. We don't have a higher high or higher low within this area here that I've grayed out. Okay, and that's what we call a consolidation phase. The market is basically in a range, is bouncing up and down, but it's going nowhere. Okay, so again, depending on the time frame you're looking at as well, right? Sometimes you zoom out, then there's not much of consolidation, but you can see this is another example of a consolidation. Okay, we have a low here that's established, and then we also have a high that's established here based on this point, and the market basically trades within this range. Okay, so this is what we call market consolidation. Okay, so I hope that gives you the understanding of what this term means. Okay, cool. Let's see next question. Astrid asks, how do you determine the amount of leverage that you have? The leverage is usually determined by the account when you open it. Okay, so you can't really change it. Okay, and you just need to work with whatever leverage you're given. Okay, so suppose when you open an account, the leverage is 50. You'll be trading with a 50 leverage in all position. Okay, so again, you don't need to really go and calculate, the margin required and sort of, because at the end of the day, the more important aspect is actually the management of your position size, right? So if you base on, let's say you put in a $10,000 account, or you put in a $1,000 account, you need to then first calculate every trade I take, how much am I willing to risk? If I'm willing to risk 1%, so 1% out of 1,000, for example, is $10. Okay, so when you calculate based on that, okay, automatically when you enter a trade with your calculated position size, you are managing your risk already. Okay, and oftentimes if you're risking less than 10% per trade, you would have sufficient leverage anyway. Okay, you have sufficient leverage and you have sufficient margin to work with. Okay, unless you tell me I would like to go all in, okay, then of course the calculation would need to factor in, the leverage, the margin required for you to risk everything. Okay, but again, that's not the proper approach to do trading. Okay, so again, leverage to me is more to understand it, but oftentimes you won't really max out your leverage. You won't really need to use it much. Okay, so I hope that helps. All right. Could you explain pips? So just now we very briefly go through that. I'm not sure if it's clear enough. Okay, but in terms of FX, this is the definition of it. Okay, so if you don't have a Japanese yen pairs in it, you look at the fourth decimal place to calculate a pip, right? So every change in the fourth decimal is 1 pip. If you have yen inside it, like dollar yen, euro yen, pound yen, okay, then you will look at the second decimal place. That will be 1 pip. Okay, so of course the market will not move, just 1 or 2 pips in a single day. Usually the average movement can range from, about 40-50 pips in a single day to some pair ranging from about 100 pips in a single day. Okay, so that's the explanation on that. Cool. Okay, where can I learn about trading in detail? This is actually asked by Ivy. Good question. Okay. again, there are many resources available in today's context, right? You have like books if you prefer reading. You have YouTube videos, a lot out there if you prefer, someone who actually learn better by video format. Okay. But the only thing I always stress is, again, with more information readily available is a good thing, but you need to then develop the skill set to filter things off, okay? Because again, I witnessed a lot of over exaggerated content, a lot of like overhyped content on social media as well that over promise, okay? So you need to be filtering some of those content away, okay? But yes, okay, I think today you go on to YouTube, you can learn a lot about it. Okay, you can read up on books. Books are usually the better alternative, right? The reason is because books usually are not overly hyped, right? They're written by proper traders out there as well. And you can always refer to this to guide you a little bit, right? So if you want to study a little bit more, there are different aspects, right? So you have the technical aspect that you can study, you have the macro aspect, you have the risk management aspect, you have the psychology aspect of trading. This again gives you a bird's eye view, right? If today you say, oh, I want to start out, I want to focus maybe on the technical first, then you want to focus on content that guides you in technical analysis. But then you're also aware that this is not everything, right? In trading, right? If you want to learn more about trading, you need to branch off maybe to macro, you need to branch off a little bit to psychology. That's where after studying a little bit more about technical, I need to start to do about macro as well, right? So then that's where you pivot and start to learn more about macro, and then you put things together, right? So that's hopefully giving you a little bit of insights into how to start learning, where you can find information, right, for IB. Okay, good. I'll take a couple more questions here. I'm not sure in terms of timing, am I okay to maybe just stretch it a little bit more? Okay, so over here, Douglas asked what time frame do I usually use? For me personally, I use most of the time is the 4-hour, H4 and H1. Okay, so those are the two major time frames I use. Enzer asks, do you prefer to trade with indicators or without? So for me, I don't. Okay, I don't use indicators. I do only use one, which is the relative strength index, RSI, but I don't rely on that much. It's just more of a confirmation indicator, right? But I do use some tools to help me analyze, like Fibonacci retracement, Fibonacci extension. Those are like measurement tools in the market, right? So I do use those, okay? So Enzer asks, do you currently trade full-time? Yes, but the definition of full-time doesn't mean that you're gonna trade the market 8 to 5, right? A lot of times people have a misunderstanding that full-time equals to 8 hours a day sitting in front of a desk and trading. That's not necessary, okay? Again, depending on the style of your trading as well, okay? If you're doing like very, very short-term trading, yes, you need to be in front of your computer. But if you're doing more of a swing style, which you focus a bit more on the higher time frame, you really don't need to be in front of your computer all day, okay? Good. Okay, Keen here asks, is there a recommended time frame that we should trade or any sort of rules to help to decide what time frame we should start to trade? If you're fairly new to trading, I always would suggest stick to the bigger time frame, okay? Because you have more time to actually analyze the approach, the market, okay? Because if you go to a lower time frame, the market moves very fast, and you may not have sufficient time to do your analysis properly. You may be affected because the price keeps moving, okay? And then you may feel, what we call FOMO, the fear of missing out, and then you just make decision rashly. So for me, if you're fairly new to market, always stick to a higher time frame. It's always easier for you to get started. Okay. Brett asks, what is your approach towards trading? Are you beats and leverage always consistent, or they vary from trade to trade? For example, 0.05%. Okay, for me, I always stick to a pretty consistent risk, okay, which means every trade I take, the risk range between 0.5% to maybe at most 2 to 5% per trade. If I'm very, very comfortable and confident with that trade, then I'll take a higher risk. if that trade is a little bit of what we call a counter trend, you know, it's a bit more aggressive, I'll go on a lower risk profile trade, right? So maybe I'll take 0.5% risk on that trade. Okay, now again, the leverage doesn't change, okay, because once you open an account, the leverage sticks, okay. The only management that you really do is the lot sizing. Okay, yeah. Okay, Ivy asks, are there any specific resources you would recommend? Okay, I would say if you are very new to FX, you can go over to this website called babypips.com. Okay, they're able to break things down very simple and easy for you to digest, right? So very quick one here just to show you. Babypips.com, you go to learn. There's this, you know, how to trade school, right? School of Pipsology. You can go through this, right? The beauty about this is it breaks very complex terms into easy to understand and digest content. But of course, you can't have the expectation that if you go through this and then you become a master trader. Okay, but it does lay a very good foundation for you. Okay, so this would be one of the, I would say, proper content that you can kickstart. Okay, in terms of any books to recommend, there is, I would say, there is the author. I would say this one. Okay. Now, this book itself doesn't really talk about any particular strategy, but it's a book that I would recommend everyone to at least read through. Okay, so basically the title of this book is called One Good Trade. It's something that is a book that will give you a good perspective into what actual trading is. Okay, you won't find any specific strategy into that, but it gives you an understanding of what real trading is, what are some of the elements that constitute to, you know, being a trader, what are some of the things you need to develop to be a good trader as well. Okay, yeah, so that's the one. Go. Okay, Douglas asks, how do you cope with losing trades, okay, or losing streaks? One direct way to do that is to take a break. Okay, I mean, if today you have, you know, I mean, like 2 or 3 losing trades, I don't call it a losing streak. Okay, that's pretty common, right? 2 to 3 trades losing. But if today, I would say anything more than a string of 5 trades consecutive, okay, is a good time to take a break. Okay, and of course, when you take a break, you want to also review, right? Are those losing trades due to you making mistakes, right? Or, you know, is it due to the shift in certain market condition that the strategy is not performing as great? So there are many factors that can affect, you know, the losing streak. Okay, but I would say if today you experience, you know, a consecutive 5 losing streak, you may want to take a break and review a little bit. Okay, but seldom you would actually have a streak of 5 losing trade, right? But anything between 2 to 3 is pretty common, right? Sometimes you might take 2 losing trades concurrently, 3 losing trades concurrently. But anything beyond 5, you know, is, I would say, is a good time to take a break, okay, and kind of review, right? What's the cause and the reason of that losing streak? Okay, is it something that you can work on, or is just, you know, I would say stupid mistakes? Okay, if it's a stupid mistake, then there's nothing wrong with your strategy. It's really just a human error of it. Okay, and then all you just need to do is take a break, reset, come back, you know, once you're, you know, mentally ready onto that. Okay, Keen asks, in your opinion, which do you recommend beginners to start, stocks or FX? To be honest, there's no real difference to that. Okay, each asset class has its own characteristics and has its own specifics details that you need to study and learn. But the approach of trading in general is more or less the same. Okay, so the question I think is, which one do you prefer more, right? I think you need to have an interest in it for you to really study it. Okay, some people prefer to study the global macro perspective, right? Like what a current country is doing, and therefore maybe currencies will be a little bit more interesting to the person. Some people would be preferring a little bit more into like, studying certain industrial trends, understanding certain companies' performance and things like that. Then of course, naturally, that will be the stock market. Okay, so there's really no right or wrong. There's no which one is better. You need to identify which is of interest to you, right? Because if today you have no interest in something, it's very, very hard for you to pick it up. Okay, you definitely want to have an interest in it, and you would then, put a bit more effort. Okay. TY asks for lower time frame, 5 minute, any resource to start trading and test. I mean, if you're looking at technical approach, generally all technical analysis can be applied on any time frame. Okay, so whatever we covered today, if you want to test it out on a lower time frame, it's very, very possible as well. It's just you need to factor in things move very fast. You need to perform your analysis faster as well, because things can shift fairly quickly. Okay, you need to make decision really on the ball. Okay. Anzer asks, do you do prop firm trading before, and what do you think of it? I did not enter the prop trading firm or any prop trading firm before. Okay, but today's context, there are many different opportunities in prop trading, right? You have the online kind of version. There's also the offline kind of version, right? I think at the end, you need to figure out what are some of the requirements of this prop firm, okay, before you make that decision on whether it fits you or not, okay? Because some prop firms' requirements are quite strict and quite hard to hit, okay, and that's their business model, right? So if you realize that it's a little bit difficult to fit into your trading style, then yeah, okay, you probably would not want to go towards that. But I know some traders, their personality, their style of trading do fit into those prop firm. Okay, then of course, they do perform very well in that as well. Yeah. Yeah, so I think with that, maybe I'll pass the time back to Junkit to do a little bit of a closing for today's session over here.
Yes, thank you very much, Kar Yong. I just gotta say, on behalf of Phillip Nova, on behalf of the participants, we really like to say a big thank you, because I think what you shared has been really interesting, and we can totally feel that from the amount of response in the form of the Q&A that we have. I think that's remarkable. Thank you very much. So I hope that all of you who are staying until this hour have benefited very well from this session. Okay, so we hope that with all that you have learned, you'll be able to up your trading game a bit, and then to apply these techniques and knowledge to this trading challenge. So right here, this is just a brief recap of the trading challenge. The start of the trading period will start next Monday at 5 a.m. Singapore time. Okay, so for the 3 weeks from 21st August, you are free to trade any contracts on Phillip MetaTrader 5. So these include Forex and also various kind of contract for differences on the platform. And then at the end, or rather at 12 p.m. SGT on 8 September, that is when we will do a cut-off. And the top winners in terms of the equities at that time will be deemed as the winner. And we look forward to seeing all of you personally, physically, on 14 September, where we will announce the top winners, and also there will be a networking event. And then I think it is also worth noting that for those of you who be actively participating, hopefully most of you, on a daily basis starting next week, we will be updating the daily leaderboard on our Phillip Nova Instagram account. So we encourage you to just scan the QR code at the center right here to follow us on Instagram, because next week onwards, throughout the trading period, we will be updating with you, or to you, the daily leaderboard of this trading challenge. So I think it will be really interesting and give you this motivation, or this motivation to just keep trading and to be better. And by that way, you can know where do you fare among the other participants. Okay, and at this point, if you still haven't registered for the trading challenge, you can scan the QR code on the left to participate in this trading challenge and stand to win attractive prizes. And lastly, also feel free to join us at our Phillip Nova Young Investors Telegram channel, where we'll be able to share with you any updates, or you can receive daily updates from us. Okay, and also just to add on one point finally on the questions or how you can learn more about trading. Actually, I believe that Kar Yong is very humble in the sense that he doesn't bring up his own course. because in fact he also does his own course online. So basically what you have experienced just now for the past 1 hour is only 1 hour. It's just a snippet of what he can offer. So he actually have this I think a 7 day or 7 day e-learning course which he offers. So I think he's charging at about $100. But after this trading challenge, if you're interested in that course and if you open a live account with us, we will be able to sponsor you to this online course for free. Okay, but I think we will come to this part later on, which will definitely communicate with you through email or other methods. But we are happy to share that we do have all these kind of resources here to support you and to help you grow as a trader with Phillip Nova. Okay, I think with that, I think I'd just like to conclude once again with a thank you and gratitude to Kar Yong, our speaker for today. Thank you for sharing your knowledge and experience and insights with all of our aspiring young traders and young investors for today. Okay, I think that is all for today. Thank you very much, and we look forward to seeing you at the Trading Challenge next Monday. Bye-bye.